Imagine you have saved up $1,000 and are wondering how to invest it to make a substantial amount of money to pursue your dream of traveling to some of the world's most amazing places. Your study led you to put all of your funds in a few well-known stocks which you intend to sell at a profit. But just as you are about to sell your shares, their values start to drop sharply, and when the value of a share falls, the price follows. You can consider this situation as a stock market crash. It creates panic among investors of losing their money and drives them to sell their stocks fast and at a low price, potentially causing a large number of people to lose a significant amount of money they have invested. Now you might be asking, what caused the sudden big drop in the value of stocks? And what should you do in this particular situation? Well, I have gathered 10 ways to help you understand what causes them and how to deal with them if you find yourself falling into such an unpleasant situation. So watch the video, make notes, and remember to give me thumbs up for worrying about your future investments and well-being. Coming up with number 10. Stop panicking in this situation and try to analyze the situation with an open mind. A stock market crash occurs when a company's stock value nosedives. Panic plays a huge role in these crashes, as does selling stocks when you think the company is going to fail. Let's take coronavirus as an example here. 2020 was a significant year. Panic over the coronavirus pandemic led to toilet paper stockpiling. As a result, there was a global shortage of toilet paper. Can you imagine how funny and scary it sounds at the same time? The same kind of panic can cause a stock market crash. Once investors see other investors selling off their stocks, they get nervous and start to sell theirs as well. Number 9. When others are selling stocks, take advantage of the situation because it is an excellent time to buy cheap stocks when the stock market is in crisis. You should always have a list of potential investment opportunities with you. So when the market crashes, you will have the money you need to buy them quickly. You can buy excellent stocks at reasonable prices and hold for a long period of time. In this way, you will almost certainly get an outstanding ROI when the time comes to sell. Number 8. Focus on long-term investments by having stocks from strong companies in your portfolio. It helps you stay invested in tough times. Strong companies have a higher chances of recovering when the market rebounds. This is a pretty big deal to check your portfolio for secure investments. The company's financial history, marketing team, management team, and industry competition all play a huge role in determining a stock's stability. Remember that the best investments will pay off for years, if not decades. A company that isn't lucrative, popular, or growing rapidly is nonetheless a solid investment prospect. Focusing on a stock's long-term potential can help you protect your assets from market instability. Number 7 should be dollar cost averaging. Simply put, it is a type of systematic investment that may give efficiency during period of market crisis. Sounds confusing, right? Alright, don't worry, let me give you an example. Imagine every 2 weeks you get a $1,000 paycheck and you decide to put half of your money into large cap mutual fund and half into a S&P 500 index fund. Half of your $100 contribution over 10 pay period are shown in the table below. As the index fund's value increased and decreased, you were able to profit from the market's volatility. Number 6. Try to stick to index ETFs. While stock market crashes are frightening, there are ways to prepare for it. One option is to invest in index ETFs, particularly S&P 500s. An index ETFs is a collection of stocks that track a certain stock market index. An S&P 500 ETF tracks the S&P 500 index. This means it holds around 500 stocks in some of the largest companies in the country. The S&P 500 has a flawless track record of surviving market crashes. It has survived the dot-com bubble, the global recession, and global pandemics such as coronavirus in 2020 over the last 2 decades. If the market crashes again, there is a very good chance the S&P 500 will rebound. Number 5. Investment diversification is the king. A well-diversified portfolio is very likely to have at least 10 to 15 different stocks in the mix. In a market crash, if you have a large amount of money invested in only 1 or 2 stocks, you could lose all of your money. Double-check that your investments are properly diversified to ensure they can recover from market volatility. Number 4. Having an emergency fund should be on your list of things if you really want to survive a market crash. An emergency fund is a savings account set up to protect you against unexpected events like job loss or medical issues. An emergency fund of 6 months of monthly expenses should be set aside to protect against unexpected events. Saving enough money for emergencies will allow you to survive a crash and fulfill your needs without having to sell your stocks at a loss. As Warren Buffett said, we customarily keep at least 20 billion on hand so that we can both withstand unexpected insurance losses and quickly seize acquisition or investment opportunities even during times of financial turmoil. Number 3. Debt is your biggest enemy at the time of a market crash. If you really want to survive, you need to do the following things. If you sense an upcoming market crash, selling part or all of your stocks and paying off your debts may be the wisest alternative. This is an excellent idea if you have a lot of high-interest debt, such as credit card bills or personal loans. At the very least, you will have a highly steady balance sheet while the bear market rages. Another alternative is to pay off your mortgage in full or at least a large chunk of it. Cutting your monthly expenses is always a good idea as well. Number 2. Simply owning stocks will not result in any financial losses in the event of a market crash. The risk comes from selling stocks at the lowest price. So what's the fix? Well, do nothing as stock falls. It's really that simple. If you leave your portfolio alone and wait for things to calm down, you will not be affected in any way. Besides, there won't be much else to do but stare at the numbers on your computer screen. To be honest, stock market crashes are scary, whether you have been investing for years or are just getting started. After all, seeing your portfolio's value fall overnight is terrifying. A stock market crash can be devastating to your finances, but it doesn't have to be the end of the world if you plan ahead. Remaining calm during a market crash could make the difference between a successful recovery and a significant financial loss. Coming up with number 1. There is always potential risk involved in any investment, but your risk tolerance will determine how much risk you can take. It's advisable to know your limits. If you have a poor risk tolerance, for example, you may sell your stocks the moment they start to drop. But if you prefer to live life on the edge, you may choose to ride through times of intense price fluctuation only to see how much money you can make. This is it for today, guys. I hope you guys liked the video, and if you did, please give a like and subscribe to my channel, and please click on the bell icon beside it. Thank you for watching. I will see you in the next video.